In 2012, one of the most respected names in enterprise software decided it needed a spy, not a metaphorical spy, an actual one, a person on the inside of a rival company feeding back its secrets. The company was Pegasystems, a Massachusetts software firm worth billions, run by a chess master turned billionaire founder. And the rival it wanted inside of was a smaller, faster-growing competitor called Appian. So Pega's head of competitive intelligence, a man named John Petronio, called up a staffing agency. And the job request he sent them is the kind of thing that, years later, a jury would read out loud in a courtroom. He wanted a developer with deep access to Appian software. That part was normal. But then he added a condition. Make sure, he told the agency, that this person was not loyal to Appian, because Pega did not want it getting back to Appian that Pega was doing this work. Read that again. He wasn't hiring an expert. He was screening for someone who wouldn't tell. The search led them to a man named Yuyong Zhu. Zhu was a software developer. By day, he worked for a government contractor called Serco, and Serco happened to license Appian's platform, which meant Zhu had a key to the building, so to speak, legitimate, working access to the exact software Pega wanted to take apart. So, Zhu started moonlighting, quietly, on the side, and what he did for Pega over the next 2.5 years was extraordinary. He sat down at his computer and he recorded himself using Appian's software, walking through it, narrating its strengths, pointing out its weaknesses, where it broke, where it was slow, where a salesperson could attack it. Nearly 100 videos, roughly 200 hours of consulting work. And for all of it, Zhu was paid a grand total of $23,608. That's the price, apparently, of a competitor's playbook. Inside Pega, they knew exactly what this was. Petronio didn't call Zhu a consultant. In internal messages, he called him his spy, and he gave him a nickname. He called him the other Matt. A private joke, because Appian's CEO was a man named Matt Calkins. They had their own Matt now, their inside Matt, and they were careful. When Zhu's tutorials got passed around the company, someone blurred out his user name on the screenshots. They gave him an alias, because if his name ever got out, the whole thing fell apart. But internally, the videos traveled. They cascaded through Pega's product teams. Engineers watched them. The head of product management watched them. The information got folded into sales briefings, documents that told Pega's salespeople exactly where to hit Appian in a head-to-head deal. And here is the number that tells you why it mattered. Between 2013 and 2021, Pega and Appian went head-to-head for the same customers more than 200 times. So this wasn't a curiosity. It was a weapon. And for years, it worked. And nobody on the outside had any idea. So how did it ever come out? Here's the part that feels almost written for television. In 2015, Pega let Petronio go. The man who built the whole operation fired. The next year, 2016, he got a new job at Appian, the very company he had spent years spying on. He climbed the ladder there, eventually becoming their senior director of market intelligence and strategy. And in 2020, sitting inside Appian, Petronio told Appian's lawyers what he had done. The spy master handed over the whole story to the other side. Appian sued. The case went to trial in Virginia. 7 weeks of testimony, dozens of witnesses. And on May 9, 2022, the jury came back. They found that Pega had willfully and maliciously stolen Appian's trade secrets, and they put a number on it. $2,036,860,045. It was, at the time, the largest jury award in the history of the state of Virginia. In the 2 trading days that followed, Pega's stock dropped about 28%. The market looked at that verdict and saw something close to an extinction event. A penalty bigger than the company's entire yearly revenue, a debt that grew by roughly $122 million a year in interest just sitting there. For the next several years, that verdict was the single heaviest weight on this company. Every investor who looked at Pega saw the same thing first. The spy, the $2 billion, the risk that it could all come crashing down. But here is the thing. That story, the spy, the verdict, the $2 billion, that is not actually why Pegasystems is interesting in 2026. Because in 2026, something strange happened to this company, and it has almost nothing to do with the courtroom. Today, Pega trades for around $30 a share. It is down more than 55% from its high. It is sitting at a 52-week low. And yet, a dozen Wall Street analysts are looking at it and saying it could roughly double from here. So, which is it? Is this a great company on sale? Or is it a falling knife dressed up as a bargain? Let's actually look, because the answer is more interesting than either side wants to admit. Start with the case for cheap. On the surface, Pega's numbers look like a business in decline. In early 2026, revenue actually fell about 10% year over year. For a software company, falling revenue is supposed to be a death sentence. The algorithms saw that number and dumped the stock. But that drop is, in large part, an illusion. And to see why, you have to understand a quiet change in how Pega gets paid. In the old world, Pega sold software the way you'd buy a car. A big upfront payment, recognized all at once. Great for this quarter's headline number. Terrible for predictability. In the new world, Pega rents its software, a subscription, and under accounting rules, that money gets counted slowly, spread out over years instead of booked all at once. So when a company switches from selling to renting, something weird happens. The headline revenue number temporarily shrinks. Even when the actual business is growing, you're trading a big one-time number for a smaller number that repeats forever. And underneath the shrinking headline, Pega's repeating revenue is booming. The annual value of all its contracts grew to over $1.5 billion. The cloud piece specifically, the highest quality, stickiest part, grew 29% to over $900 million. And the backlog, the money already under contract that simply hasn't been counted yet, sits near $2 billion. Then there's the cash. Pega carries zero long-term debt. In a single quarter in 2026, it generated more than $200 million in free cash flow. And it's guided toward roughly $575 million for the year. It's using that cash to buy back its own stock at the lows. And at its big 2026 conference, Pega rolled out a pitch aimed straight at the most expensive problem in corporate AI. The unpredictable runaway cost of running these models, what people in the industry call the token tax. Pega's answer was to charge customers a flat price per finished task instead of per click. Predictable AI pricing in a moment when nobody can predict their AI bill. So, that's the bull case, a cash machine hiding behind a scary headline on sale. And what about that $2 billion verdict? Surely that's still hanging over everything. Here's where you have to be careful, because this is the part that gets reported wrong. On January 8, 2026, the Supreme Court of Virginia ruled, and the headlines said the $2 billion verdict was overturned. Which is true, the number is gone. For now. But overturned does not mean Pega won. And this is the distinction that matters. The court threw out the verdict because the trial judge had made serious errors. The jury had been told it could treat almost all of Pega's sales as damages, without Appian having to prove which sales the spying actually affected. That's a flawed way to calculate a penalty, so the damages number got vacated and the whole thing got sent back for a new trial. But, and this is the part the bulls skip, the appeals courts also looked at whether there was enough evidence that Pega actually did it. And they said yes. There was. The finding that Pega misappropriated trade secrets was supported. A separate finding that Pega violated Virginia's computer crimes law, Pega never even appealed. That one is final. So the honest version is this. Pega is not off the hook. The catastrophic number is gone. The company gets a fairer fight on how much it owes, and that's a real win. But it still has to go back to a courtroom. The interest is still ticking at over $100 million a year, and Appian is pressing forward. The risk didn't disappear. It just got smaller and blurrier. A little like a certain consultant's username, which brings us to the case for Trap. Because the bull story has a load-bearing assumption, it says, ignore the falling revenue. The backlog will convert into real recognized sales over the next year or two. If that conversion happens, the stock is cheap. If it stalls, if customers shrink their contracts, if the layoffs sweeping corporate America mean fewer software seats, then the falling revenue isn't an illusion at all. It's just the truth, arriving early. And not everyone on Wall Street is convinced. After those 2026 results, several firms actually cut their price targets, not raised them. At least one independent valuation model pegs the company's fair value down in the mid-30s, barely above where it already trades. The same backlog the bulls call a guarantee, the bears call a promise that still has to be kept. So you have a company that genuinely lost a corporate espionage case, that's genuinely seeing revenue fall, that genuinely faces a retrial, and that is also, genuinely, a debt-free cash machine trading at a steep discount with a real plan for the AI era. Both things are true at the same time. That's what makes it hard. That's what makes it interesting. And just to be clear, because it matters, none of this is advice to go buy or sell anything. This is a story about how to read a company, not a tip on what to do with your money. The whole point is to see all of it, the good number and the ugly footnote sitting right next to each other, before you decide anything. Because here's what pegasystems really is. It's a test of whether you can hold two opposite ideas in your head at once. The market wants a simple story. Buy it, it's cheap. Avoid it, it stole something. But the real companies, the real decisions, almost never come that clean. In 2012, a software company decided it needed a spy, and it spent years making sure no one could see what it was really doing. In 2026, the market looked at that same company and decided it was worth half of what it used to be. And it still can't quite see what's really there. Two different decisions, 14 years apart, and both of them are still waiting on a verdict.